Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This presentation is given in October 2019. Once again, I'm going to be updating you on the monetary patterns around the globe, although this time I really want to be focusing very much on the United States and really on an idea which is emerging in the debate on monetary economics. The idea is called modern monetary theory, and it's been discussed quite extensively in policy circles in the last 2 or 3 years. In particular, it's been discussed, allegedly at least, among the Democrats in the United States. Now, it's possible that 18 months from now, America will have a different president, and at the moment, the front runner on the Democrat side is Elizabeth Warren. She has said one or two things about modern monetary theory, not in my view with any very obvious blessing for the ideas, but there we are. And the essence of modern monetary theory is that the government can borrow from the banking system and use the proceeds of the loans from the banking system to spend money on anything. It sounds pretty irresponsible, and that is the attitude, indeed, of most economists. But let's just try and pin down this subject more precisely. If Mrs. Warren's views about this subject are rather uncertain, it is clear that Alejandra Ocasio-Cortez, one of the torchbearers of modern democratic beliefs, she has given more blessing to these ideas. She said that the government doesn't need to balance the budget, and implied that there may be a case for monetary financing of the budget deficit. Now, I'm going in the next few minutes just to discuss a critique of these ideas from Larry Summers. Larry Summers was an advisor to President Obama, and although not in any sense a right-wing economist, he is indeed opposed to excessive borrowing from the banking system, and has said that examples from the developing countries show that there's too much of this. The result beyond a certain point is inflation, and in the extreme, even hyperinflation. And if I could just quote from Larry Summers, because I think this is pretty much a standard view. He had an article in the Washington Post earlier this year. It's just not true that governments can create new money to pay all the liabilities coming due. At a certain point, it leads to hyperinflation, or a collapsing exchange rate, increased interest rates, risk premiums, capital filling the country, lower real wages, and so on. Pretty standard kind of analysis. Well, I agree with Larry Summers on that, but then I'd point out that he has a problem. Because separately, in the discussion I gave last month, I pointed out that Larry Summers said that monetary policy is exhausted, that we had to rely on increased budget deficits to stimulate the economy. Look, Professor Summers, you can have one of these ideas or the other, but not both. You see, the guts of this subject is that there's only a certain amount of money that people, companies, and so on want to hold, given the price level. If the quantity of money is expanded too much beyond a certain point, then there's inflation. Technically, agents have a finite demand for real money balances. And that idea is the key proposition in the quantity theory of money and monetarism. And to me, it's very odd that Larry Summers should have alleged that monetary policy is exhausted in some of his recent articles, which I criticized last month, and also said in March this year that modern monetary theory was dangerous and might lead to hyperinflation. You can have one proposition, but not both. The problem here, understood more generally, is that economists are not agreed about a monetary theory of national income determination. There's a lot of dispute about which measure of money is the most important one, or the one that policymakers should be focusing on. And because of this lack of an agreed understanding about how money affects the economy, you get these debates about such very bad ideas as modern monetary theory. However, there is a sense in which modern monetary theory is right. And what I want to present in the next few minutes is a discussion of the American financial scene in which I'll explain exactly that sense and I'll really pin it down because I'm going to give you the results of an organized presentation about how money affects the US economy. In all of my work, I focus on a broadly defined measure of money. That means a measure of money dominated by bank deposits. Let's take it that we're trying to organize monetary policy to achieve inflation of, say, a bit under 2%. Some people regard that as price stability. The Federal Reserve, the European Central Bank, the Bank of England, all kind of regard inflation, small rise in the price level each year, about 1 to 2%, as acceptable. There is an increase each year in the amount of money people want to hold because of the increase in real output. In America, let's say that's about 2% a year normally, on average. There can also be some rise in the price level. Take it at around about 1.5%. Let's also assume, to give us some leeway to be easygoing about this subject, that it's quite common for the ratio of money to rise relative to income and output by about, I'll call it 0.5% a year. So we've worked out that, roughly speaking, growth in the quantity of money broadly defined of about 4 to 4.5% will deliver, not utopia, but at least fairly stable macro outcomes with low inflation. I then actually checked the data, and can I just emphasize I hadn't looked at numbers before making it, and I just checked the figures, and I was rather intrigued to discover that the annual compound percent growth rate of USM3 from January 2011 to August this year was in fact 4.3%. Now, so I'd say that, roughly speaking, gives us our prescription. Now, that period, the 2010s, is increasingly being regarded as another great moderation, great stabilization, if you wish, after the Great Recession. And so I'm just going to take it that it is that kind of number is what we want in terms of growth of broad money in the USA. Now, mostly it's bank deposits, mostly it's liabilities of the banking system. It then follows that if we're to have 4.5% growth of broad money of bank deposits, there has to be growth of something on the other side of banks' balance sheets, on the asset side of the balance sheet. Okay? And what I've just done here is to look at the assets and liabilities of the US banking system, the system regulated by the Federal Reserve, as of last month. You can see all those deposits, those liabilities, about 13 trillion of them. One or two other liabilities, of course, that banks have, some to their bondholders, some to their investors, their shareholders. Let's take it they won't change very much. Then there has to be growth on the other side of the balance sheet, and the assets that I've focused on here are claims on the private sector, some miscellaneous trading assets, treasury securities, claims on the government, and the banks that cash have, mostly with the Federal Reserve. So we need to get this, to achieve this macro stability, we need to have the system growing at around about 4.5% a year. If it grows at, say, 3% a year, then we'd expect disappointing growth in the short run, possibly falling prices in the medium term. And conversely, if the rate of growth of money is, say, 6% plus, we might have some rather buoyant economic activity in the short run and inflation in the medium and longer terms. Now, another complication that also relevant here are the assets and liabilities of the money market mutual funds. And I'm going to now just make a leap and say that, in fact, the amount of total money in the USA we need to think about is getting on for 20 trillion dollars. That compares with 21 trillion expected US GDP in 2019. And I'm going to say that 20 trillion of money is split between claims on the private sector of around about 14 trillion and claims on the state, on the federal government, on the Federal Reserve, all this cash that the banks have got, of around about 6 trillion. Now, if we have growth of 4.5% of broad money, around about $800–900 billion, then there has to be some growth of the assets also of around about that kind of number, 7, 8, 900, maybe trillion dollars. And in this sense, there is what one might regard as a free lunch on the asset sides of the banking system every year. In the sense that if money has to grow a certain amount to be associated with growing output and a little bit of increase in prices, there has to be an increase in the banking system's assets as well. And if one was being very careless and thoughtless about this subject, one might say that can all go to the government. I said that the American banking system, considered in the large, with all the money, mutual funds and so on, has got about 20 trillion of assets, about 6 trillion of claims on the US state. Couldn't that just expand by much more? And then doesn't modern monetary theory seem to be correct? Well, one has to admit to the modern monetary theory apostles, to people who really believe in this stuff, that there was a period in the early 2010s when this kind of analysis made some sort of sense. Because the introduction of the Basel III rules meant that banks had to reduce their risk assets, they had to reduce their claims on the private sector, and therefore it was important for the government to borrow from the banking system through operations called quantitative easing. QE meant that the shortfall in banks' claims on the private sector could be made good by the increase in the claims on the public sector. But that's all in the past. There is no credit-free lunch at the moment because the American banking system is experiencing reasonable growth of its loan assets, claims on the private sector, and in fact in the last year or so those claims have been growing at around about $500 billion, figure like that. There is really no room at all for the US government to borrow from the banks. The larger problem here is that the USA is running a large budget deficit at the moment. The deficit in 2019 is expected to be around about $1 trillion, and at unchanged policies, it's expected to be about $1.2 trillion way into the indefinite future. So the ratio of public debt to national output in America is rising. Suppose that the American government were to borrow that full sum, that $1 trillion, from the American banking system every year. Let's suppose that the private sector didn't borrow at all from the US banks. Then it's clear that 20 trillion stock of money, US money, would rise by about 5% a year. If all the federal spending were financed by the budget deficit, and if all of it were to be associated with growth in the quantity of money, someone's talking more like, say, around about 4 or 5 trillion a year, then obviously the rate of growth, the quantity of money, rises towards 20%, 25% a year. In the USA, obviously massive inflation, the USA becoming like Argentina. Let's come back to more plausible reality. Let's suppose that the American government borrows $200 or $300 billion a year from the banking system. And let's also suppose that the private sector borrows $500 billion a year from the US banking system. Then we have, roughly speaking, 800, maybe 900 billion a year growth of the US stock of money, which is going to be obviously these numbers of something like 5%, something like that. That's not too bad. But once we get up towards the growth of banks' assets of something like 1.5 trillion, 2 trillion a year, then money growth is moving up to 7.5%, 10%, and we start to worry about inflation down the track. So, just try and bring all this together. Because we're using a organized monetary theory of determining national income, focused on broad money, we can make conjectures about the inflation consequences of different patterns of budget financing. We can bring that into the macroeconomic picture, we can analyze it and say the extent to which modern monetary theory is wrong. The trouble with many of the critics of modern monetary theory is that they're very imprecise. Larry Summers says it will lead to hyperinflation. Well, when? How much money growth would cause that trouble? What I've done today is try and set out a numerical framework, a quantified framework, thinking about these issues. It does turn on my approach to determining the level of national income from the quantity of money. If you don't believe that, that's okay. But then I'll ask you, you can make all these statements about money and inflation. What is your precise answer to these questions? All right? I've got one. You haven't. And I would in particular want to criticize the American monetarists who tend to focus on either narrow money, M1, or even the monetary base. Look, I'm sorry. There is no very useful connection between the monetary base and M1 and the growth of US national income. That's why I always come back to the importance of behavior of broad money in the analysis of macroeconomic trends. Okay, well, I just want to finish. The very last point I want to make is that, coming back to the very current situation we're in at the moment, and that is that if anything at the moment in the USA, the growth of broad money is rather high. In fact, in the last 4 months, the annualized rate of growth has indeed been up at these kind of 10% or so figures. If one then delves into the credit side of the banking system, looks at the asset counterparts to the growth of broad money, you'll see that the main reason for this, there has been some growth of credit to the private sector as usual, but what's been different from the past has been rapid growth in, yes, American banks' holdings of US Treasury securities. Now, it may be that the motive here is coming from the banks, that they've been expecting the Fed to cut the Fed funds rate, so they've been picking up the treasuries to get the capital gain from the fall in the yield. That may be what's been going on. But also, I suggest this may be the beginning of the sign of trouble, that the US Treasury has got this $1 trillion a year deficit to finance. It can finance it a bit from overseas, can finance a bit from the American pension fund industry and insurance companies and so on, long-term funding. But if it borrows too much from the banks, that'll cause faster growth of bank assets, faster growth of money, with all of those macroeconomic consequences I was talking about. Thank you very much.